hidden retirement taxes are one of the things that can cost you thousands of dollars while in retirement. Many people do not see them coming, and as a result, they do not plan for them. One of the most impactful of these, and one of the least known of these, is something called IRMAA. Just what exactly is IRMAA? We're going to get into that now. Medicare is the United States version of senior health care. When you turn 65 years old, you are eligible for Medicare. And the idea is they're reduced premiums compared to what you'd get on the private market, and you get offered a wide array of services. With Medicare, there are a number of aspects to it. So there's Part A, which is hospital services, Part B, which is professional services, Part D, which is the drug plan. There's also Part C, which is what Medicare Advantage is eligible under. So you wouldn't claim Part C, if you wanted to get that route, you'd go Medicare Advantage. So the way Medicare works, Part A, for most people, there's not going to be any monthly cost. For Part B and Part D, there is a monthly cost. So here's how this works. So as we have on the screen here, for Medicare Part B, if you're a single filer and you make $109,000 a year before deductions, you pay $202.90 a month for Part B. And then you'll pay a little bit more for Part D as well. However, if you go even a dollar above that $109,000, guess what? You're now paying $284.10 a month. You go a dollar above $137,000, now you're paying $405 a month. So let's put this into perspective here. $137,000 is only $28,000 more than $109,000. Yet your Medicare costs are doubled. Your Medicare Part B costs are doubled, even though you only made $28,000 more than the minimum threshold. And that's just for you. Now, if you're a married couple and all of a sudden you go above this 274 mark, congratulations, you're each paying this. So for the household, that's $800 a month compared to 202 times 2, so about $400 a month. Now, it keeps getting higher though. That's not even the highest level. It keeps going higher and higher. Now all of a sudden, your Medicare costs could have tripled or even more just because you didn't see this situation coming. And I ran into a situation where there was this couple, and they were doing well, right? I know some people are going to say, oh, they're doing well. They had a strip mall that was generating $230,000 a year, in addition to some pensions and Social Security. They were not even 65 yet. They did not realize that they were running head on into a freight train. They did not even know this tax existed. So if you have a higher income, not only are you going to be in a higher tax bracket, not only then is your Social Security now going to be taxable, but your Medicare is also going up as well. And so here's the problem with this. This does not take into account what your expenses are. These Medicare brackets are not leveled out based on what the cost of living is in your area. So if you're in a really low cost of living area, all right, you may be doing great. But if you're in California, if you're in New York, if you're in certain areas of Florida, $137,000 is not even that much. If you're living in Los Angeles or Orange County or just really most parts of California in general, $137,000, you're barely above the poverty line. And guess what? They're charging you double for Medicare. How do you feel about that? And so this doesn't go away. The way IRMAA works, there is always a constant 2-year look back for IRMAA. So for 2026, they're looking back at your 2024 tax return. For 2028, they'll look back at your 2026 tax return, so on and so forth. What happens to a lot of people is their IRAs, their 401ks grow, and they get to the required distribution age. And then all of a sudden, the money that's being generated, they're always in IRMAA and they're effectively in IRMAA prison for the rest of their life. We don't want that. And so the way to really think about this and approach this is there's two factors. If you're not in Medicare age, you've got to be thinking about what can I do to make sure that I don't have taxable income that puts me over this threshold, because that's an important way to think about it, because tax-free income does not count towards IRMAA. So if you have money coming from a Roth, or you have money coming from municipal bonds or life insurance or wherever it is, that money is tax-free. So you could be having the same amount of money coming in, but if a large portion of that money is tax-free, you might not even be eligible for this. That's if you're before retirement. Now, if you're in retirement, what you need to be thinking is, do I want to find a way out of this? Even if it may, in the short term, put me at a higher level. Because once you're at Medicare age, you've really got to think about like any extra tax is going to affect you from a Medicare perspective, right? Any extra taxable income. Should I take more taxable income now, pay IRMAA for a year or two, but eventually have the chance to get out of IRMAA prison and I'm not paying anything extra for Medicare anymore? Because otherwise, your accounts keep growing. Your RMD is a percentage of your account. You're likely your IRMAA is going to keep going up and up. Your Medicare costs are going up. Your taxes are going up. You're paying taxes on 85% of your Social Security. Does that sound like a good system? Good plan? No? If it doesn't, we got a link down below. Sign up for a consultation with us. We'd be happy to walk you through this. There's no charge. You're not committing to purchasing any, we don't have products, or purchasing a product or anything like that. We just want to go ahead and help you out. If you're not interested in that, but you did like the video, make sure to subscribe and leave a comment down below. Thank you and have a great rest of your day.